I'm now joined by Ernst Osiander, who is our global head of bonds. Ernst, will global bond duration perform in the second half of the year?
I believe so, yes. The main reasons for a positive performance of bond markets in the second half of the year should come from central banks and a further improvement in the outlook of inflation. The global interest rate cycle is turning, and we already have seen a number of developed market central banks cutting interest rates. Others will follow, including the Fed, who we expect will start cutting interest rates in H2. And once rate cuts have started, this should not be a one-off, but the beginning of an easing cycle. We also forecast for the US a moderation in growth and a weaker labor market, which would support a bond-friendly market environment. But there are, however, a number of caveats and risks out, which caution against becoming too optimistic regarding the rates outlook. Firstly, and apart from the usual forecasting uncertainty for inflation and central bank outlook, yields for intermediate and long-dated bonds have already fallen and are already trading well below central bank rates. So that will make it harder for them to rally even further. Secondly, there are a high number of fiscal risks, or significant fiscal risks in a number of countries, including the US, and this can lead to a higher term premium. And let's also not forget we face election uncertainty in the US in autumn. And while all these factors will likely temper bond market performance and can lead to periods of high volatility, at least temporarily, they should not prevent duration to perform in general, as we expect an increasingly positive outlook for central banks to be the dominant force for rates markets over the course of the year.
Thank you, Ernst, for those insights.